Welcome back to Cheddar's Opening Bell. Stock futures still pointing to a higher open despite this morning's job report, which came in well below expectations. For more on this, we're joined by Michael Darda, Chief Economist and Chief Market Strategist at MKM Partners. Michael, good morning to you on this Friday. Why are investors not more concerned with the dramatically slowing recovery of the American job market?
Good morning. I think investors are simply looking over the horizon here. So this was a disappointment. The numbers came in well below consensus expectations. Job growth was more than cut in half from the previous month of October. And so the question is, what's going on with the market holding up so well? And I think what's happening is investors are looking over the horizon into next year as the vaccine comes online and the reopening effort is bootstrapped. And we should see much better numbers as next year unfolds. And we could be at full economic health far sooner still than widely anticipated. But this is a setback, not a completely unexpected one, right? We know that recently the COVID numbers have gotten a lot worse, and we're seeing local restrictions being put in place. And that's obviously having an effect on economic activity, but probably not a permanent one.
I do want to break the jobs numbers down sector by sector. Employment in transportation and warehousing rose by 145,000. Professional and business services increased by 60,000. Half of those, though, we should note, are temporary. Healthcare added 46,000 jobs. Construction and manufacturing added 27,000 each. Skipping down to retail, though, that sector lost more than 34,000 jobs. Why do you think that the trucking and transportation industry is succeeding so much in this moment? I mean, or do I even need to ask, just with all the online shipping and everything else?
Yeah, absolutely. It's interesting. If you look at overall retail sales, they've actually fully V-shaped rebounded from the hit that they took early on. So they've already fully recovered, but it's really the services sector, services consumption that really was devastated. And even with a strong rebound in previous months, we're still 8 or 9% below the previous growth path. So if we think about next year and where the recovery really needs to lift areas that have been devastated, it's really going to be in those services industries that have been the hardest hit by the pandemic.
Talking about retail, that sector lost jobs at a time I think, would traditionally think around the holiday season that there would be job increases. How do these workers retool themselves for a new economy, assuming that these trends that we're seeing with online shopping and e-commerce will likely continue even post-pandemic?
Yeah, those are trends that have been underway for a while, and certainly they were dramatically accelerated by the impact of the pandemic as there was a sudden forced transition to a stay-at-home economy. The good news is that a good chunk of that will reverse as the vaccines come online. Those structural trends are still going to be in place, right? The old brick and mortar retailers were already having a tough time before the pandemic. But the portion of activity that was interrupted exclusively due to the pandemic and the shutdowns and now the recent setbacks that we've had on the pandemic, a good chunk of that will come back. And you still do have those structural trends in place that workers are going to have to deal with. But if the recovery is fast enough next year and policy is supportive enough, and we think it will be, eventually those workers will get taken up in other areas of the economy. That doesn't mean it's going to be an easy or a seamless transition, but we should reach some semblance of full employment by the end of next year, in our judgment.
What does that economic policy look like from your perspective? Joe Biden is expected to talk this afternoon about this jobs report. He's previously said that even if Congress were to pass some sort of slimmed down stimulus package, just say within the next couple of weeks, that much more would still be needed. What kind of things do you think he might be looking to do?
Yeah, it's interesting. It looks like we're moving closer to a bipartisan agreement now on a package that's around 900 billion. If you look at the level of compensation in the US economy, which was devastated by the pandemic and has been recovering, but we're not back to where we were, if you were to fill that entire hole, it's around 400 billion. So these numbers, 900 billion, now that's a compromise down, from well above that number, could end up being, simply fuel on the fire next year as the vaccine comes online. And we shouldn't forget the Federal Reserve has an aggressive, open-ended policy of bond buying and pinning short-term interest rates at zero until we're below 4% unemployment and the inflation rate's above 2%. And so incoming President Biden may want to do additional fiscal support beyond this $900 billion measure. I'm not sure we're going to actually need that. So I think next year is really going to surprise to the upside, despite the disappointment today on these numbers.
All right, Michael Darda, Chief Economist and Chief Market Strategist at MKM Partners. Really great to have you on this morning. Appreciate it.